On this episode of the podcast, I have with me Samir Kumar. He is the co-founder and general partner at Turing Capital. We're going to be talking about platform shifts in technology, and things happen in waves. Winners are not always right out the gate. And we're going to be looking at that from a VC perspective. And you got to talk about AI. I don't think we could actually do an episode where we don't, but we're also going to talk about it in terms of what's happening in different areas. Where is AI really going to make a big difference potentially down the road? And will revenue models shift, right? We're seeing a lot of different products come out, different ways that they can take advantage of technology, and we're going to see if there's anything shifting there with Samir. And there's other things that we want to get to. I just don't know if we'll have time. So Samir, thanks for being on the show.
Thanks for having me, Amir. Looking forward to it.
Absolutely. Yes. Excited to have you on Turing Capital. Tell us a little bit about what you guys do there.
Sure. We're based in the Bay Area, typically focused on doing software-centric investments at the Series B stage. So we like to come in when companies have achieved anywhere between 3 and 10 million in ARR, have demonstrable product market fit, and then we like to be on the journey with them in terms of how to scale and get through the inflection point of becoming a growth stage company. We are not necessarily looking at very specific industries or this vertical versus that, but we tend to be focused more at the application level. We're looking at things that are either vertically integrated, where you have the core underlying machine learning and AI capabilities, but on top of that, you have an understanding about particular industry workflows, what are the personas you're selling to, you know how to reach those customers, and you're solving an application level problem. And maybe the latest and greatest advances in AI are just a way of achieving greater efficiency, unlocking new use cases. But it's certainly not investing in companies where, large language models or AI are a hammer and everything looks like a nail. We come at it more from, this is a bag of tricks, and this is just the latest bag of tricks to allow you to be more efficient or allow your customers to be more efficient. We, mostly do Series B. We like to lead and co-lead. Occasionally, we do go a little bit earlier. For example, I just did an investment in the UK in a company called Cusp AI. I can tell you more about that. And occasionally we go a little bit later for portfolio construction reasons, given that this is Fund 1. But the vast majority is Series B. And then the last thing I'll say is we are investing globally. I would say probably 2/3 in North America and 1/3 probably outside. So Europe, India is a great market for emerging software companies, Australia. So we are definitely looking outside of the US as well.
I guess, talking about platform shifts, especially companies that might be exploiting these opportunities through a software platform, software application. We've seen different waves in the past. I don't think these are new concepts. I think when you compare this wave, or how would you compare this wave of AI to recent past? Obviously, we saw a lot of conversation around the metaverse. We saw a lot of conversation around crypto, blockchain. And we go back a little bit further, but obviously just to kind of a couple more recent trends that maybe they haven't quite hit the market the same way as what we're seeing around AI.
Yeah, so I think you can look at platform shifts or kind of new disruptive technologies on different timescales. And if I just think about my own career arc, I can go all the way back to the early 2000s. And if you think about in that time frame, the new hot thing was mobile and smartphone computing. And really, the pivoting of, access to the web, access to applications, whether business or consumer, and being able to do everything from your phone or your mobile computing device. But if you think about the time horizon over which that platform shift played out, it was almost a decade. So quite a long time, and the world looked very different from when I first got involved, in the early 2000s, around 2000, 2001, to, by the time it was very clear that iOS and iPhone was going to be a leading player and Android was either a close number 2, or sometimes they would swap places between who was first or second. And I think what's interesting is, when I go back to my early days of mobile, it was about BlackBerry, it was about Symbian, it was about Nokia, certainly Windows Mobile and Pocket PCs and things like that. Those are not things that we were talking about as mobile became mature and the platform shift had fundamentally already taken place. It was about Android and iOS, and the vast majority of profits in the industry were going to Samsung and Apple, but these were the two dominant platforms, but they were nowhere to be seen in the early days of the cycle. Similarly, if you think about the shift that happened in cloud, Amazon was a bookseller, right? And Amazon came out and AWS became a thing and the leading cloud platform. Microsoft ran hard and fast to transform their business from on-premise package shrink wrap software to becoming cloud native. And Google wasn't even a player in the early days. Google Cloud came much later, and now obviously Oracle Cloud is there too. But this shift also happened over quite a long period, many, many years. And I think what's also interesting in that both of these cases, the incumbents were not necessarily like in pole position to really capture the shift in the market. So if you think about cloud and a lot of the infrastructure build out, the tooling build out that happened in the early days of the cloud era, there was a lot of opportunity for startups because there was a lot of white space that whether it was Amazon or Azure or other kind of core platform players, they weren't serving the market with all of the tools and infrastructure that was required. And there was a lot of M&A as a result. I mean, these companies got acquired. They got, whether it was the big hyperscalers or consolidation that happened in the market, but it was because the incumbents weren't, in such a unique position that they could very quickly close that white space. I think, and I'll come back to talk about, metaverse and crypto. But if we look at what's happening now with AI, the key difference is the incumbents are very, very well positioned. Some of it is structural because of the access to compute that's required and the investments that the hyperscalers have made in the compute infrastructure. The role that NVIDIA is playing in becoming the default infrastructure provider for building large AI models. But also, if you think about, OpenAI technically is a startup. I mean, it's a very large company. But whether it's OpenAI and Microsoft or Anthropic and others or Cohere and others, they're moving very fast. They're listening to the same customers that startups are listening to. They're evolving their APIs. They're evolving their platforms. And this is happening on the time scale of months, not on the time scale of years. And so what that means is if you think about this platform shift, how a startup that's a new entrant in the space and how they navigate, will they be able to sustain themselves? Will they be able to thrive? It's a very different world than it was during the early days of cloud and the early days of mobile. And I think for us in Turing, the lens we like to put on it is just because you're first out of the gate doesn't mean you're the long-term winner. We've seen evidence of that in the past. But here the risk is if you're doing the horizontal tools and infrastructure and you're a seed and A company, you have to look at early successes with a little bit of I don't want to say skepticism, but certainly a good amount of like, hey, is this really going to persist in the long run? Or is it a version of what we saw, for example, in the early days of Apple's App Store, where you had people building flashlight applications and other kind of small tools that they weren't getting maybe as part of the core platform. But there was always this talk about, another iOS update, and so many App Store companies are now extinct because it's a core part of the platform. We see things like that now when OpenAI does their next dev day, or the big hyperscalers do their platform updates. How many startups are going to go extinct as a result of that? So I think that's one big shift here. I think when you look at the metaverse, to me, I think the metaverse issue was more about, do we have the right endpoint hardware to really immerse ourselves and consume ourselves in this idea of the metaverse? And I think we're still waiting for that ultimate form factor. Certainly Apple and Vision Pro, still a very high price point, but a huge leap in terms of quality and performance and what I can experience, but still a developer device. And we've seen a series of developer devices, whether it's HoloLens or Magic Leap or Vision Pro. Certainly MetaQuest is at a lower price point. The idea of the metaverse, I think, is going through that transformation. If you think about the Gartner hype cycle of the peak of the hype, the trough of disillusionment, and kind of a long-term enlightenment that you reach, that happens in different time horizons depending on the platform you're talking about. Lots of reasons for people to be cynical, skeptical about crypto, and we went through a huge crypto hype phase, and then as a result of some market forces and kind of a crypto winter, things have kind of consolidated. But it doesn't mean that the fundamental technology of blockchain and distributed ledgers, that was hype. It's just the time frame in which we realize that value in what applications is longer than we all expected. And that's, to me, in some ways, human nature. We tend to overestimate things in the near term and many times underestimate their impact in the long run. And I would say the same for AI, right? I fundamentally believe it's a truly transformational technology. Andrew Ng has compared it to electricity. I think that's a very good analogy. In the long run, the pervasive impact of AI, I do believe, will be along those lines. But I think we are getting ahead of ourselves in terms of how much we've hyped things up and what will happen in the near term versus, let's say, over the next 5, 6, 7, 8, maybe even 10 years.
I guess a question for you regarding, long run winners aren't always out the gate first. There's a couple of things at play that I think are interesting. I love your thoughts on them. One, we are seeing, in this case, no one's asleep at the wheel. In fact, it's the large enterprises that are making the largest investments into AI infrastructure, all these Gen AI startups. I mean, even the startups themselves are receiving funding by some of these really large companies because they just want to make sure no one's going to come eat their lunch because they could see the risk for Microsoft and their whole entire software model and the way Google interacts and the way Amazon sells. I mean, these are all threats they all see. They all are seeing this. We're seeing massive investments across every type of AI entity. And I guess the real question is typically, startups take advantage of a capability, functionality, a new model, a new idea that the market hasn't seen. That's what really creates that avalanche, that big boom. In this case, where maybe we are not seeing that same dynamic because it's so visible, it's like we're all seeing the train. We're just going to swerve around it. What happens to, I guess, smaller startups? And also, if long run winners aren't always out the gate first, where's the startup play in this scenario? Because the large companies are moving so fast that can a startup even get an MVP without somebody else going, well, we'll just add this functionality, your product's dead. I mean, we've seen OpenAI do it. You mentioned them. I think in the last 2 iterations, people are just going, well, half of these startups are just gone. They're irrelevant now.
Yeah, I mean, it's kind of an existential question, and I think as an investor, my optimistic lens is never underestimate entrepreneurs. The innovation that they'll come up with, the ideas they'll come up with, and the natural kind of structural setup of being in a small company, and maybe your back is against the wall, you're on a short leash in terms of how much runway you have, how much value you have to create with how much capital you have. Just the culture and the incentives that creates, we've historically seen great things come out of that, and I think that will continue. But at the same time, we're also starting to see the first evidence where if in this platform shift, if startups are going head to head with the big platform companies, that is extremely risky. So if you look at what happened with Inflection AI, right? It raised a good amount of money. The co-founders are now at Microsoft. Microsoft sort of acqui-hired a big portion of the team and has an interesting licensing deal with the company to license their tech. If I was an investor and I had put in, participated in over 1.3 billion in financing over a couple of years, I was not going to be underwriting that to the kind of return profile that I saw from Inflection in terms of getting my capital back, maybe a little bit more. I was thinking this is going to be a big company, multi-billion-dollar exit, maybe even tens or hundreds of billions of dollars. Just to see that is shocking, it's surprising, but I also don't think it's the last. I mean, we've now seen, buzz in the community about, hey, maybe Adept is socializing itself to other big players, including Microsoft. Maybe Character AI is doing the same. Until recently, there was questions about the survivability of Stability AI, till they did this new round and had Sean Parker come in and throw the company a lifeline. But what's common in all of these companies, right? They are at the foundational layer, they're at the very horizontal layer. They're building, frontier models or foundation models that are very broad and horizontal. They require tons and tons of compute. The running joke in VC has been, you're giving equity dollars to startups that are taking and going and buying NVIDIA GPUs. So why not just go invest in NVIDIA directly? You probably have a more surefire way of making a return there. So I think right now there's a few factors that are going on. If you just all the credit to NVIDIA and what they've accomplished, and it's really incredible. But if you think about, there is an inefficiency in the market. There's a single vendor that has all the pricing power in the compute that they offer. it's energy intensive, it's compute intensive, huge data center footprint. That naturally gives an advantage to these incumbents who have been building hyperscale cloud solutions and know how to deal with infrastructure at these very large scales. So you can ask yourself, well, if that ever changes, if now all of a sudden there's some kind of democratization of how much compute is required to innovate in this space, whether I'm building a broad horizontal foundation model or just doing AGI research, that could fundamentally change things. But right now, it seems like that's the path that we're on. And so in a world like that, that natural advantage going to the hyperscalers, and more than half of NVIDIA's business is coming from the hyperscalers. It begs the question then, is it the right use of equity dollars for startups to run hard and fast and try to compete head on in saying, hey, we're going to build very large AI supercomputers, or we're going to go and give a bunch of money to the hyperscalers to reserve all of that compute, or maybe we're building our own? Is that a winning path? And I think that's the open question. And I think we're seeing evidence that that is going to be more capital intensive than maybe investors or even founders have appetite for. And so I think everyone naturally believed at some point we would shift from focusing on the foundational building blocks to more things up higher level in the stack, more application level things. And I think that's going to happen sooner than later, because whether it's in cloud or mobile or in generative AI, startups and entrepreneurs understanding a particular industry and a particular industry problem, and then going and really focusing maniacally on that to go and solve that problem, versus the big hyperscalers, which are like Lego block companies. Yeah, they could do some of that, but they're never going to say, hey, we're going to really just become very focused on one industry versus another and provide a truly vertically integrated end-to-end solution that is best in class. So I think that opportunity is still there for startups. It doesn't mean that in the horizontal layers, there's no opportunity. Like, for example, if you think about cybersecurity, and if you bring cybersecurity and generative AI together, we fully expect, whether it's Microsoft or Palo Alto Networks or CrowdStrike, they will, of course, innovate there. But this is clearly an opportunity that there is a little bit of a greenfield now. Like, how do we protect AI? And what are the cyber tools that are required to protect AI? And I think we're seeing a healthy kind of competition and emerging ecosystem of startups that are chasing that opportunity. And I think there's good historical precedent for enterprises to continue buying that from startups versus only focusing on large established incumbent players to service those new kinds of cybersecurity requirements. So that's another one. But yeah, I think the main message here is, if you're going to compete head on with the big hyperscalers in generative AI and the horizontal layer, you better be on to some big breakthrough that nobody knows about, because that's going to be a very tough uphill battle.
I think that's great insight, and I think when we and we'll come back hopefully and talk about revenue models and monetization shifting in a second, to kind of stay with areas that people can win at, right? So obviously we're talking about, if you're going to go buy GPUs from NVIDIA and try to compete with these large, massive companies that have a lead, that's a hard proposition. Like, I don't know if I'm not smart enough to see that. There's an angle there. There's tons of founders executing. Power to them. If you're looking at areas, if you're a founder, that you can take advantage of this generative AI, is it going more narrow? Because obviously we're seeing lots of platforms that are trying to be broadly consumer centric. Is there an opportunity to go more narrow within, and you'd mentioned some areas of science, robotics, medicine, health. Are there opportunities for founders to get really deep into the actual subject matter and not try to solve? Traditionally, you want to solve the largest TAM, and that's what you're going after. VCs love that. Is this a case of, can you potentially find those narrow areas where you embed and you become indisposable? Companies have to use you.
And what you just described is actually a core belief of the Turing team, right? And so maybe the best way to say it, if you look at people doing broad AI research or AI frontier models, one way of looking at it is, okay, you're a jack of all trades, but maybe a master of none. And some would argue that, look, as these big frontier models get bigger and bigger and bigger, they will in fact be able to master many, many different tasks. but it's not trivial, right? There's amount of tuning and effort and specialization in the data you're collecting for those particular industries or particular scenarios you have to go and do. So if you're an entrepreneur, do you want to burn dollars building this very broad horizontal capability and then pruning it down to solve specific use cases? Or does it make more sense to say, look, I'm going to let's take AI for science, because that's an area I'm passionate about. Latest Turing investment, a company called Cusp AI, which is tackling material science with generative AI. If you really focus on that particular problem or that particular domain, and then say, what is a narrow form of AI? Let's call it task-specific foundation models I can go and build. And these task-specific foundation models are not hundreds of billions or a trillion plus parameter models chasing AGI. They're like, hey, we're trying to figure out how to do molecular dynamic simulation in chemistry. Or we're trying to figure out, how to generate new molecule candidates. Maybe that's something that you can do in less than 10 billion parameters. So already the compute is a lot more tractable. You have a very clear idea of the kind of data you need to go and collect. And oh, by the way, that data is not available as pre-training data on the internet as part of Common Crawl. So it's not something that is already commoditized that anybody can go and get access to. It will require some effort. There's probably going to be a proprietary nature to it. So if you start to narrow on industry-specific or scenario-specific use cases, that informs what kind of data sets you're going to build, what kind of data you're collecting. Is there an opportunity to build a proprietary moat there? It will force you to really understand the users and the personas that are immersed in those workflows you're trying to accelerate. What are their pain points? And it just brings kind of a purity of focus in what is it that you're trying to solve. And you're trying to be a master of one thing or two things versus a jack of all trades. And I think that to us seems like the right approach in terms of the kinds of entrepreneurs that we would want to bet on.
It's interesting. I could be wrong. If I'm wrong, correct me, or if somebody out there wants to correct me. But MicroStrategy, when they've, and I'm from DC, so I think I know the story because I think I've heard it enough maybe. But they started based on a consulting project, and they happened to retain the IP, but it was a narrow focus because the company needed something. I kind of listening to you, and I'm like, we've seen a trend towards startups looking to solve big, massive problems or problems that have not been touched in a long time. But is there an opportunity to kind of go back to the way some companies like MicroStrategy, and I think there's others, I think we can even argue that Microsoft and DOS and how that came about for IBM, that was not exactly how startups are founded. Now, is there a shift maybe we could see to people going, you know what? There's these specific use cases. If I can retain the IP and deliver in this narrow, fashion, all of a sudden, where it goes, because like you said, you need that access to the training data, and maybe it's not PAM driven anymore. And to kind of tie into the revenue models, monetization side of it, is that going to allow for these to be more interesting to VCs? Because all of a sudden it's not just TAM, maybe it's a different way these companies are producing revenue.
That's right. And I think when we think about TAM, you can put different lenses on TAM. You can just talk about kind of raw, how big is the market, how many potential users are there. But I'd say a more interesting way to look at it is, can you reach the people that are willing to pay meaningful amounts of money for a solution to that problem? And even if there aren't, ginormous numbers of them, but if you can reach them, the segment addressable market is significant enough, and you have the ability to price things in a way to make it a interesting business. And then, of course, in the era of AI, do you have some path to collecting proprietary data to make sure that your solution is best in class? And by you interacting with these customers in this particular segment, your data is getting better, your product is getting better, and there's a flywheel that's being created there. In Turing, we would be more excited about something like that. And, there are limits to it. So like, hey, my TAM is, $50 million versus my TAM is $500 million versus my TAM is $5 billion. But in order to serve these different segments, I would say 50 million is probably too small. Even if you've got something compelling, you're just going to hit a ceiling. But if it's a 500 million opportunity and you're kind of the best positioned to clean up and do a land grab, and then think about adjacencies you can expand into once you've nailed that market, I think that's compelling versus out of the gate, I'm chasing a $5 billion TAM. There's 10 other companies that are in it. I have to maybe not just do my core competencies, but a bunch of other things to go and capture that market. I personally would like the focus of someone that has somewhat of a smaller TAM, but is very well positioned to go and capture that opportunity, and then think about market adjacencies that they could go into from that point onwards.
When you look at, because I know I mentioned we might talk about monetization and outcome-based pricing, how is that going to drive how VCs evaluate companies? Because obviously licensing and fees, how traditionally we've seen licensing work, or per seat basis or per user basis or whatever that is, that could be shifting. Is that going to cause a VC to start reevaluating that side of the house?
Absolutely, and it's already happening. We're seeing this in a couple of our portfolio companies, and it just goes back to what is the promise that we're making with AI and generative AI, which is we will force multiply your productivity. You will be able to do more with less. Now, an extreme version of this that everyone is obviously worried about is job loss, right? And if you're saying doing more with less, I don't need as many people. A more optimistic version of it is to say, I can do a lot more. I can force multiply the people I already have in terms of their output and their productivity. But in both cases, the challenge you have with let's just take software licensing and the typical seat-based licensing model. Now, if you're saying you can do more with fewer people, well, then you're maybe in a deflationary mode in just terms of how your revenue is going to look year over year, if in fact you're delivering on the promise of your capabilities. So obviously, no one likes that. Entrepreneurs don't like that. Investors don't like that. But we've seen precedent in the past, and in certain kinds of businesses, this is more common than others, where you are basically measuring the productivity, measuring the outcome, the number of transactions, the number of deals, whatever the metric is that need to be completed, and you're pricing based off of that. And so in a world where you go to this outcome-based pricing, you're basically saying, look, forget about how many people were involved in delivering that outcome. Did you achieve the outcome? Or did you achieve something better than what you had expected to achieve? And therefore, we are justified in pricing our product based on those outcomes. One example where this is probably now front and center is in professional services and more kind of services-oriented businesses. They tend to be human capital intensive. You have a certain number of bodies that you're deploying at a customer or a client, whether you're a law firm or a consulting firm. And so now you have tools that would allow you to not necessarily keep throwing bodies, but be able to augment the people that you have and either achieve that outcome at a faster pace or be able to maybe service more clients in parallel. And so for those types of businesses, you want to see like a focus on outcomes versus how many people and how many hours are we billing the client. I don't think the client or the service provider just wants to focus on billable hours. If they could put less people on it and still charge the client the same, and the client saying it's about the quality and the quantity of the output, and that's what I want to pay for, you have interests that are aligned. So I think we're starting to see the first signs of this in software propositions that are aiming to solve productivity problems and focusing on the outcome versus just, hey, pay me this much per year based on how many people you have in the company that are using my product. I think historically, one of the challenges with outcome-based pricing has been attribution. If you say there's a particular outcome and maybe your capability or product was a portion of it, well, how do you pro rata allocate what your contribution was versus other entangled factors? But now with AI and the product being able to deliver a certain capability, this becomes more measurable. You can say, well, we were able to, I'm doing a customer call center. I was able to process this many more calls as a result of having a LLM-based chatbot interacting with my customers versus, in the past, if it was like, well, is my customer satisfaction gone up by this much? Well, maybe AI had a portion to do with it, but there were other factors that were involved. And so how do I attribute those things correctly? So I think we're in a better position for attribution, but it's not like it's perfectly solved.
I love it. I think there's probably a second episode somewhere here because I think we just scratched the surface on some of these things. I know you got to get back to it, Samir. I really appreciate you being on. If somebody wants to connect with you to follow up on something you said or just learn about Turing Capital, what's a good way of contacting you or connecting with you?
Easiest is just drop me a note. It's just Samir@turingcapital.com. You can also find me on X at SK121 is my handle. So feel free to send me a message there. On LinkedIn, you can just find me Samir Kumar at Turing Capital. So any of those are fine.
Okay. We'll make sure we include some of those in the show notes so people can connect with you. Again, thanks for your time and thanks for being on the show.
Great to be with you, Amir. I enjoyed it.
Absolutely. That's it for the episode. Two things. One, I think we didn't obviously exhaust the topic, and we might have to have Samir come back for episode
totally
2.
There's a lot more I know in that list that we had. We didn't even get to touch.
We did. You know, you guys don't see the list, but we actually have a pretty lengthy list of ideas we wanted to get through, and in 30 minutes, I think we did okay, but there's actually a few things that we need to have him back on to talk about that I think are really even maybe a good continuation from this discussion. So share this episode with somebody else that is interested in what we're talking about, platform shifts. Long run winners aren't always the first out of the gate, talking about some of these outcome-based pricing. I think it's a great episode. So share with others, please. I'd appreciate that. And also, like, subscribe, comment. Let me know how the podcast is going for you. Until next time, thank you and goodbye.